Morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-Noe with my co-host Kevin Casey, and today we are joined by Dr. Selma Hepp, CoreLogic's Chief Economist. Selma, thank you, Dr. Hepp. Sorry, so happy to have you here.
It's okay. Nice. So happy to be back.
Yes, thank you, thank you. Oh my goodness. Okay, before we get going, so I don't forget. We have a YouTube channel, people. Please go to it and subscribe. Mortgage Pros 411. I get emails pretty regularly from people who are like, "Oh, I really love it, and I have a meeting, and can I watch it?" So go to our YouTube channel, Mortgage Pros 411, one more time, and subscribe. And then you'll get a little pop-up on your YouTube channel when we post our meetings or our shows.
If you subscribe, though.
Right, but you can still watch it even if you don't subscribe. So don't worry about that if that's too, stressful somehow. Anyway, bottom line is our friend Jason Bellevue handles our YouTube channel for us. So when he and he's very good about being on top of it. Sometimes he'll get, like COVID or something and not be able to for a little bit. But anyway, all of our shows are there except for we can't post CFPB. Other than that, they're all there. So go watch them, put on 1.5 speed, crank through them. It'll be great. I also want to mention we are part of the Crispin Media lineup at this point. And so they have a website, so you can go watch all the shows that they're doing, including ours, but ours all go back to the YouTube channel anyway. So make sure you're checking out what they've got going on. And then finally, last but certainly not least, we have NMLS classes live and in person, and we have set them up in different parts of the state. So we have Southern California, Fresno, Northern California, a few in Northern California. So if you would prefer to do your continuing ed in person, and you would like to see our smiley little faces all day and hear us talk instead of somebody else droning on and on, you could listen to us drone on and on. So we're going to send out something showing where those classes are, but we have one coming up on September 23rd, right? That's quick.
Yeah, that's pretty quick. And the other thing too is, I've looked at other ones. It's like, would you rather learn the stuff from a loan officer or someone who's like a compliance expert telling you what you're doing wrong?
Well, you want a nice combo of both, right? You want somebody who actually something and can speak to something. And you also, it's nice when you have somebody who's on the ground, just like you are, just like we are, doing loans every day. So, all right, September 23rd is the first one that we are doing in Sausalito at the Yacht Club, right on the water. It's so stunningly beautiful. So start there. Okay, it's a big week, a big week. Happy to report the 10-year is at 3.64. Yay. Tomorrow we have, what is it, Kevin? What's happening tomorrow?
I think there's some important guy who's supposed to be coming out and saying something.
It's housing starts and building permits. That's what's tomorrow, right? Dr. Hepp, what's happening tomorrow?
It's just a regular Wednesday, with the Federal Reserve, just kind of having a chat and having a press conference, nothing big.
Right.
Exactly. The whole world's only going to hold on every word he says.
Exactly. Like, forget about whatever the Fed rate decision is. It's what is he going to say afterwards? What is the dot plot going to look like? How many Fed members were for or against or looking for? How many are they projecting out? They're going to tell us how many, it's incredible.
How would you like that job to make that announcement?
I would.
I wouldn't.
Everyone's every single, how you paused, how you said something. Oh, they're going to critique every piece of it.
Oh my God. Yeah, well, that is the essence of it. What's really interesting to me is, so prior to the weekend, the Fed futures were showing that it was a 100% chance we're going to have a 25 basis point cut, but a 15% chance that we'd have a 50 basis point cut. Now, remember, we had a senator screaming from the rooftops a couple of weeks ago, demanding a 75 basis point cut. So whether we think that politicians of any type, whether they're in the presidential office or in Congress, should be impacting monetary policy, that's a whole nother conversation, right? But all of a sudden, we have flipped from a 50% chance of a 50 basis point cut to 67% chance of a 50 basis point cut just over the weekend. So
what happened?
So here is what I think happened. So there is a Wall Street Journal reporter. His name is Nick Timrose. I was on his website this morning, actually. He's the chief economics correspondent for the Wall Street Journal. So he's been dubbed the Fed mole. I mean, yeah, the mole. So when the Fed doesn't want to totally freak out the markets, it is thought that they will have him write a little, thing in the Wall Street Journal to give a warning shot about what's going to happen. So he published this little article over the weekend, or yeah, and that's what happened, I think. So, Dr. Hepp, what do you think? Does that sound right? Or, I mean, how do you go from 15% to 67%, if not something like that?
I mean, Nick, right? Nick Timmer's, he is, the most followed Fed commentator. And there's been times where right prior to their meeting, there were things said in his articles that, suggested that he maybe have an inside view or something. So, but he's a very thoughtful guy. I've personally met him. He's a very thoughtful guy, and I think that he thinks about this very carefully, and I would read his articles, openly, and so I think, maybe the fact that, markets always, in my opinion, markets always get ahead of themselves, and they have, again, this time, especially with the labor market report. I know you want to talk about that, but so they get ahead of themselves and expect something more aggressive than really the when you really look at underlying data is needed. So so yeah, I mean, he could be he could be maybe bringing some sentiment back into the some sense back into the, exuberance that sometimes happens in advance of these meetings.
Right. It is, yeah, I mean, you never know. I mean, that's the bottom line. You never know. I think it's interesting though, because the ECB has already cut twice, the European Central Bank. They did a 1/4 point cut, then they just did another one last week. So they've gone from 4% to 3.5%. And so typically we're a little more in unison with the other central banks, and this time we're not. And so there's also a lot of conversation about, all right, they don't typically cut before a presidential election, and this time they're going to. But there's also the idea that maybe they waited too long. So, I mean, what are your thoughts on that? Or does it even matter? I mean, like,
yeah, well, I mean, it matters in the sense that, I mean, we're here talking about it, so it matters to people a lot, but does it really matter for the markets? It's hard to tell. There's segments of the U.S. economy that are affected. There's housing market is affected. There's commercial real estate is affected. Banks' balance sheets are affected. But if I'm not buying a car, if I'm not buying a house, do I really care? Maybe not so much. So it's just sort of like it matters, but who does it matter to, and how much does it matter? It matters for the housing market, which is the most important thing for us. But what's interesting is, that how much happens in advance of these meetings anyways. So we've already now seen mortgage rates come down. We are already seeing a really solid, I feel like, response from consumers in terms of the pending home sales, in terms of maybe refi activity. It's starting to build up, and so that's what that matters.
Yeah, that really does matter. Although it was funny because especially in the last few weeks, I think most of us, the first question, or it's not even a question, it's a comment. Like, consumers they're commenting. They have a commentary on what's going to happen with rates.
Yeah.
They're like, oh, well, the rates are coming down. I'm like, yeah. So, here's the rest of it, which is it's already baked into the market. They're expecting it could go either way. So historically, depending on what has been said before or after, they could go up, they could go down. You don't always know. And those comments that he's going to make tomorrow are so important. So important.
Because if they go down a half, but they say that we're not going to raise or lower rates in November, then that would cause the rates to go up, short term at least, because there's like, oh, that's bad news, even though they got the 0.5% down. Versus if they went down 1/4 and they said, no, we're going to maybe do another half on the next one, then rates go even further down.
Well, we don't even know what the hell would happen if they said one way or the other. So thanks for like sticking that in there, Kevin.
Back to my original comment of, wouldn't you like to be the one making this announcement?
Oh my God. Oh my God. Sometimes one of us will say something and the other one's no.
But you know what I will say though about consumer sentiment, it's interesting how now with availability of social media, technology, how responsive consumers are to these expectations. And
Yes.
given that they've been all year expecting for mortgage rates to come down, there's been this sense of like, well, why do I not hold off for lower mortgage rates? And I mean, we've seen housing markets just like in limbo
Yes.
all of this year until basically like 4 weeks ago. So consumers are different now than they used to be, in my opinion, in how they how they consume this information, how they seek information, and how that impacts their purchase decisions.
That is 100% true. Dr. Lawrence Yun, I know that you are buddies with him. He was commenting on LinkedIn that the home sales did not recover in the summer as usual because there are so many people waiting for, it's the election, it's the Fed rate cut. Do they think that the market's going to crash? Do they think there's going to be more inventory? They all have an opinion, which is why it is more and more important, in my opinion, for loan officers to actually know what is being said out there in the headlines, what is true, what is not true, how can they guide their consumers? Because if their borrower does not have the right answer and they state it to the loan officer and the loan officer can't say, yeah, no, then they're not the expert. And then the consumer's not getting the best information that they need to make whatever decision they need to make. So it's all complicated, and it's not like it used to be where someone would call. I mean, I remember when I started in this industry 526 years ago, and someone would call and go, "Oh, what's the rate?" And you just had a rate sheet in front of you, and you just went, "It is whatever it was, 11%." And now I can't even begin to answer that question. I have 500 questions for you. Okay, is this like the most unbelievable hyperbole over it? Every number out of my mouth is ridiculous right now. Anyway, you get the point. Now I have to ask you so many questions to get to what is the rate. I mean, the answer is I don't know. Depends. It depends on you. So
Depends on you, exactly.
yeah, you just can't sit in your office anymore and just think, I'm just going to crank out loans. You got to know something. And if you don't, you're a disservice to the entire industry and your borrowers. But that's just my opinion, whatever. So yeah, there is a lot going on out there. So I thought it was really interesting because retail sales numbers came out this morning and they were up 1/10 month over month, but they were expected to be down 2/10 month over month. And so the mark was like, wait a minute, what about that? But there were negative revisions from last month. And last month included Prime Day on Amazon, which was, I did not know this, $14.2 billion in sales in one day. 14.2 billion in one day. So I thought it was interesting because this seems terrible. Now we're at, what is it now, Selma, year over year, the retail sales. Anyway, I think it's 1.1%, but before the pandemic, retail sales were at 3.6% increase.
Audrey, you know what my take is? You should be an economist. You have these numbers at your fingers, and I'm listening here to you. I'm like, oh, okay, good to know.
You want to know something funny? I have literally been Googling how to get an economics degree, but I know that to be credible, I have to go get a degree in economics, and I have to get a PhD, or no one will ever listen to me, and I will have zero credibility. So
you just have to take econometrics. That's the only class you need to take. Get that one out of the way. That's the hardest one.
You can be my mentor, Selma. Does that work for you?
That works for me. That works for me.
Oh my God, that is so funny. Anyway, I'm just looking at some of these numbers. And again, it's so important that we compare, these numbers with pre-pandemic, because sometimes they seem terrible and they're not so terrible compared to history, right?
Yeah. So, my take on it is like we've been waiting for the consumer to buckle, you know, this whole year, and the consumer hasn't buckled. But that just goes back to me to this idea of the wealth creation that we've had. And I don't know if we maybe have talked about this last time, but it always surprises me when I look at the, you know, wealth of U.S. Households, how much it has gone up over the last few years, especially since the onset of the pandemic. So, you know, it's not even surprising, you know, and you talk, you know, you think about, you know, U.S. economy outperforming all other economies in the world because we have such a strong consumer base, or such a solid consumer balance sheets, that you know, that's really, you know, what's driving all of this. It's that, you know, so you're going back to, you know, we're asking, does it matter? Well, we thought it was going to matter so much more what the Fed does, but it turned out really this time it didn't matter as much what Fed does in terms of, you know, the final outcome on the, or impact on the U.S. consumer.
Now, the only thing that was from a consumer's point of view, and I caught myself doing this myself sometimes, is, oh, things are bad, but the Fed's about to lower rates, so I'm not going to worry about it because they'll take care of it and then things will get better. So I'll just keep going at the pace I'm going. When in other worlds, if things went bad, they're like, oh my God, you know, things are just going to get worse. And I was talking to a friend of mine about a different country and how they think. And it was just interesting how, and this is in Europe, and how they will pinch every penny possible. And to them, money is more important than time. And in the United States, we always say time is money. And to us, our time is more valuable. And we will spend money. And, you know, that's why we're a throwaway economy versus other economies. You know, they will fix things, you know, that are years and years old, and they'll spend more money fixing it than they would have just replaced it. So it's just a different culture here in the United States.
You know what, this takes me back to the pre-meltdown, and we were in the middle of a refi boom. One of the first ones that I remembered, really, like where it was just really rocking and rolling. Everyone was stressed out. You're super busy. And I was standing at the copy machine, if you can imagine. And I was having a conversation with one of my colleagues, and he goes, what's going on? And I'm like, I am so stressed out, blah, blah, blah. And he goes, listen, if there's any problem that can be solved by money, it's not a real problem. Just throw some money at it, fix it, and move on. And I was like, oh my God, that's so brilliant. He's so right. And that's, to Kevin's point, exactly what we do, right? But I also think that, I haven't taken a dive into this month's retail sales numbers, but in previous months, even though the numbers were up a little bit, it was driven a lot by the upper end, like high-end goods. And so I was having a conversation with my buddy last night, whose son, not friend, is in, what is the college thing, Kevin, where the kids are athletes and they NHL,
NCSA.
Okay, the acronym starting
NCAA.
No, you shush. Okay, none of it makes any sense. None of that. Okay, it starts with an NILNC. Anyway, so those kids who are playing college sports right now are making millions of dollars a year. Some of them like way more than they would.
Some are making millions and some are making nothing.
Kevin, they're all making something, and some of them are. I'm literally having this conversation with someone who's talking about multiple kids in this little tiny sphere that are making millions of dollars a year, way more than if they'd gone pro. And so they're doing things like, you know, visiting dentists and having gold teeth implanted, buying a bunch of jewelry, buying fancy cars. They have nothing invested, just for the record. Their families are very poor often, and they are just out there spending like drunken sailors because it's new, right? New money. They're just like throwing it around. So I'm wondering how much of the high-end sales that are impacting retail sales, how much of it is that kind of thing? You know what I mean? Because boy, I'll tell you, you talk to the average person, they are not feeling great. I don't know.
No, I do think, I mean, there's somebody I know from Visa, an economist from Visa, and they obviously look at, you know, expenditures through credit cards and debit cards, you know, that are Visa debit cards.
Yes.
And, you know, that's that was the point of the last couple of presentations that I saw them do, is that it's the upper end that's holding up the consumer spending. It's not the lower end. The lower end is having to use more debt to to
Get
buy
by.
things, and that debt is extending longer, and you're seeing some increases in defaults for credit card debt because of that. So it is the upper end. But what was interesting too, what they talked about earlier this year, is that they finally, it was like sort of like a spring season, they were saying that they finally saw higher end buyer or higher end consumers spending less, which was a concerning sign. But that reversed back up by the end of the summer. So there was some lull in the air there, in late spring, that really felt like a lot of things were slowing down considerably, let alone just, the housing market really slowed down. We're talking about home prices for the first time went down on a month-over-month basis, which we haven't seen for a long time.
Not in the summer.
Not in the
Yeah.
summer, yeah.
Yeah.
This is like June to July, right?
Yeah.
We don't usually see that. But things are picking back up. I think you get this like, okay, things back up on the, well, where am I going with this? I lost my train of thought.
Let's get back on track.
Yeah, let's get back on track. Yeah, I'll stop.
No, I think anyway.
I was trying to say the numbers will get back on track, but
Oh, the numbers, yes,
Yeah.
yes, the numbers will get better. Yeah, and the fact that the fact that maybe we can transition into job market, but the fact that job market is not losing the ground underneath it, which after that one report in, I think it was July report, sort of looked really sketchy, but August report was better. So right, am I thinking this correctly? Now I'm confusing.
We've been saying that those numbers don't make sense the whole time.
Oh my goodness. Okay.
Yeah,
so
there's a lot of volatility. Yeah.
Kevin, anyway, so the jobs numbers, let's just carefully go. Kevin is sick of talking about the jobs numbers. He doesn't want to talk about it anymore. And I told him that just like we got so sick of talking about recessions, we're going to start taking shots every time someone said the R word. I said, you still have to talk about it. It is an issue. It is a dual mandate that the Fed has to have full employment and control inflation. And so it matters, and especially when you have job numbers that are skewed as much as ours are. So we have a jobs report that comes out. Let's just stick with BLS, which I have dropped the S or the L and just call it the BS jobs report. And those numbers, not in addition to the monthly revisions, we recently found out that they were overstated by 818,000 jobs. And then this morning I read that since January of 2022, 92% of job creations in the household survey were either part-time or self-employed jobs. And so those part-time workers, they're getting second jobs because they can't get a full-time job that is paying them enough to survive, right? So part-time is counted the same as full-time, so again, maybe if I went to economist school, I would have a much better behaved opinion of all this. But as an outsider who doesn't know much, I look at this and I'm like, how in the world? We have a Fed making policy decisions based on flawed employment numbers, which is a huge part of their dual mandate. And so I had made a comment to Kevin about, and he had come up with the acronym, the FUJN, and so you guys can figure out what that means, but JN stands for job numbers. So anyway, we're going to start a new acronym out there that we hope will stick. But it's frustrating to me because, again, I'm watching the rates go up or down based on these reports that come out. And then you have monster revisions. And if the real numbers had been reported initially, we wouldn't have had those giant swings that are impacting our borrowers' monthly payments for potentially, 30 years or however long they end up keeping a loan. So I'm just frustrated.
I think the Fed just needs to, or the Bureau of Labor Statistics just needs to get into an Uber once in a while and ask the Uber driver what they were doing before they were driving Ubers. That will give them a real sense of the economy.
That's right. Yeah. How many loan officers are out there driving an Uber? And
it's not just loan officers. I just talked to someone that were going off on how their Uber driver had just been, doing one thing and now is kind of screwed over, and now they have to, just drive Ubers, and it's just kind of across out there.
I was listening to a company meeting last week and heard that there are 47% less loan officers now
Yeah.
than 2 years ago. And I literally emailed asking, what's the source of that? Can you like tell me where you heard that? That's a big number. I mean, a big.
Did you get the answer?
No.
Okay, because I can tell you from our numbers and the when we send out loan, emails to everybody,
Yep.
how many, there was times when at the beginning of this year where we were losing hundreds and hundreds of loan
Yep.
officers each week.
Yep. That's right.
They're not so much anymore, thank God.
Or, or maybe again, maybe it's, the strong survive, and maybe the people who are, listening to this every week and really working at being professionals, just like we need professional realtors, we need professional loan officers, not somebody who gets in and out when it's easy and the rates are low and they just have, loans falling out of the sky. No, get out, stay out, and leave the real work to the professionals, is my opinion, but whatever.
Hey, Dr. Hepp, I got a question for you. And this is just a hypothetical, but we were toying with the idea, hey, what if we were able to get Jerome Powell on our show? What question will we ask? Okay. And my question at that time, and I'll throw it by you, so what you think of the answer. No right or wrong answer. We know you're not the Fed chair, but why doesn't the Fed have different Fed rates for different parts of the country? Because one part of the country could be really booming and another part can still be struggling. How is it the Fed comes up with one number for everybody?
Right, but the Fed rate is just the bank rate.
Right,
It's
what they charge the banks, but obviously what they charge the banks gets reflected in what the banks charge on the bank side.
Right.
And I realize there's some banks that are national banks, like the big boys, and there's some regional banks. But is there a way where the Fed somehow helps out other smaller regions that may be struggling with other things other than just the rate?
So you gotta always go back to what their mandate is, and their mandate is price stability and maximum employment. I don't know necessarily that you can get price stability if you have an arbitrage opportunity in the US, so that's
and that arbitrage is why things went really bad in Japan, because suddenly people were able to arbitrage between US currency and Japanese currency when they raised rates when we were lowering rates,
which actually had part of the reason why we had that August volatility in the market was what was happening in Japan.
Makes sense.
It's called the Fed funds rate, which would not be the Fed funds rate if it was a regional funds rate, but I get your point. Okay, so in other news, guess what? In case you missed it, there are lenders, that's right, in the middle of September, people who have raised the conforming loan limit to $802,650.
802?
802,650. That's right, as of now. So I just want to point out that this is not FHFA's increase of the conforming loan limits. That does not happen typically till late November, which we, in the last couple of years, have had something we called the crystal ball competition, where people would weigh in and tell us. The first question was, what do you think the new conforming loan limit will be? And the second tiebreaker is, what day do you think that the Fed will, roll out that number? Or not the Fed, what am I saying? See, I've got Fed in my head. FHFA will roll out that number. So Kevin, who loves to take a dive into the analytics of what date, which give me a break to stop, because that's our tiebreaker. You can't tell everyone. Anyway, we will still do that this year, even though in mid-September, I can't believe it, Kevin. Can you?
That's kind of a little bit early.
A little early? It's a lot early.
Well, there's only one more month of data well, no, there's 2 more months of data to roll in.
Yeah, it's early, kids. Yeah. Anyway, so with that being said, certainly.
But I have a feeling they feel that the next 2 months of data will be lower, and therefore they're pretty confident that the rate.
No, I have a totally different take. So we have a couple of, shall we say, players out in the industry, and they always want to one-up each other. And
Mhm.
so they want to make sure they're the first ones out of the gate, right?
Oh,
So
yeah,
I think it's
I think I know you are. They're out of Detroit, Michigan, both of them.
Gee, you're so subtle. You're so subtle. You really know how to play your cards close to the chest. Oh my God. Okay. So, Dr. Hepp,
Yes.
they keep talking about a government shutdown that may be occurring at the end of the month. I have even been told on an SBA loan that I am working on that I should make sure that it is closed by the end of the month, just in case SBA is impacted by a government shutdown. What are your thoughts on this? Is it the same
Yeah.
as usual, or is it really going to happen, or what do you think?
I mean, I think it's all honestly same thing as usual. It's a very strong political card to play, and given that it's election year, maybe carry even more weight. But but because it is election year, I doubt that anybody's going to be be serious about it and actually have a shutdown. I mean, it looks bad on everyone. Nobody
Yeah,
likes a
just because
shutdown.
it's election year, I'm like, that's a
Yeah,
dumb thing to do.
yeah.
But at the
It's,
same time, they have this thing with the government debt. It's at
they
record
do.
heights.
They do. They
And it's not
do.
just the dollar amount, it's the percentage versus the GDP. And it's like, I think we're
Mm-hmm.
125% of the GDP. That would be
Yeah.
like, someone owing more each month than they make each month.
Yeah, yeah. I mean, I think that's why, there's a concern about maybe long-term rates being higher long-term because of that, the amount of
I
debt
would,
we have. And
I was
so,
telling someone the other day that I think long-term interest rates are going to be rising. Short-term, we're getting a little bit of a benefit. So you would agree with that because of the deficit, that we're going to
yeah,
see
I mean, I've
long-term
definitely
rates.
heard those arguments. Yeah, yeah. I mean, I definitely heard those arguments. The question is, I think long term, like how much investment we get in foreign investment into U.S. securities,
Mhm.
that plays a role. And oftentimes, when you have so much geopolitical instability, you get influx of foreign investment in U.S. treasuries. So. Then there's a savings rate, we have aging population. So it's hard to tell. It's hard to tell. But the debt would suggest yes, but then we've been sort of expecting that to be the case, and really hasn't, until this whole roller coaster of pandemic, we just kept going down. And even like 5 years ago before the pandemic, or 6, 7, 10 years ago, we were talking about the federal debt. It's not like a new topic. It's just, it's a
It's
topic.
even worse though than it was
It's
5 or
even
10
more.
years
It is. That's true. That's
So
true.
it just keeps getting worse and worse. So yeah, so I just don't see a solution
Yeah.
because nobody wants to face it, and
Mhm.
none of us want to face it. So we blame the politicians. Okay, we don't want, oh, they don't want to fix this. Well, they don't want to fix this because they're afraid of what we're going to say to them if they take the
Yeah.
measures to fix it, which,
Yeah.
again, most people don't like. But anyway, something's got to happen before it all blows, though, don't you think? I mean, one would hope.
Well, hopefully nothing happens, but
Okay,
something will happen.
okay, let's do some odds on this, Dr. Hepp. What are the odds that
Okay.
nothing will ever happen if the deficit continues to grow, even at the rate it's growing? Do you think it will never ever be?
No, that is zero. The probability that nothing will happen is zero, but the probability that something is likely to happen soon, 0 too.
All right, fair enough. All right, so speaking of demographics, so Kevin and I have become very interested in Peter Zeihan. So he is a geopoliticist, and he has educated us on demographics and how important they are as far as forecasts and looking at what is going to happen within a population, within an economy, not just in your country, but how do the other countries all factor into that. And so currently we have the most 25 to 35-year-olds living with their parents that we've had since World War II. So it is, there's a lot of people who typically and should be living on their own, who are still living at home. And we don't have, by all accounts, enough construction. We don't have enough housing. Nothing is really giving on that. Like they're not building enough. What are your thoughts on how this is going to impact our market, housing, appreciation in the future, et cetera.
Yeah, I mean, that is my biggest worry is what happens in light of the fact that we are growing as population wise and we're not building enough, and it's been an ongoing problem. So what happens to affordability, and we're already seeing, I mean, why are kids staying with their parents longer? Because they can't afford. Potentially they see it as a my parents will just give me the property as they go to other places. But but there's this interesting argument of silver tsunami. I don't know if you heard about that.
Yeah.
About all the stock that gets released as baby boomers age out. And so I don't see the tsunami. Some made it in a very like negative light where it's just going to be oversupply of properties. I don't see that happening. I think there's going to be a slow wave of homes coming on market as baby boomers age out. But and that will help some, but it doesn't help enough.
Right.
So yes, I am worried about, and then the other thing is it's very regional. You were talking about regional trends. It's very regional. Some parts of the country are actually building quite a bit. When you look at Texas, when you look at Florida, anywhere between I don't know, Texas to Florida, that southeast region, some in Desert West, they're building a lot. Actually, there was a new home permit data, single family permit data came out a day or two ago, saying that 60% of new construction happens in 10 states. And it's certainly not California.
Right.
It's never been one of those states that ever ranked high. So you get this issue of over lack of affordability in some parts of the country, and then more affordability in other, and people migrating to those more affordable. So we've seen people already take advantage of that. It's just that, do you want to live in Texas or do you want to, then there's personal preferences. But what does that mean long term? I think, in California, for sure, what that means is less and less affordable housing, more and more appreciation. You get, people with lower incomes having to leave the state. And we've already had that, happening for a number of years. So I don't see that sorting itself out unless we really do some drastic changes.
Growing up in California, I have seen that time and time again from, all the kids I grew up with that, quote unquote, couldn't afford to live here. And they would move to places like Alabama and the stuff, and, and they're still there. I still talk to them, but, they've left the state. But it's really interesting thing is they don't come back. People that tend to leave tend never to come back because it's even worse trying to get back. Like it's hard to stay, but it's even worse to get back because if you leave to California, your property did not go up as much as the properties went up in California. So then when you go to come back, suddenly things are just that much more expensive than they were when you were leaving. Versus if you had stayed and you had bought a house here, your home would have gone up, and it's easier to stay here and get by because your home keeps going up in value.
I haven't looked lately, but when I did look a few months ago at the numbers after the supposed exodus from California, it was so grossly overstated. It was
it's totally
and
because
also when I was young, my adopted parents moved from California to Oregon, and guess who? I came back. I mean, so actually 3 out of 4 people who moved up to Oregon came back. So it happens. And also, I was just talking to my son who's in San Francisco and finishing up his senior year at University of San Francisco, and he's in tech. And thank God he's at that university because he's right in the middle of all the tech stuff. So he's talking to me about all these introductions he's getting, these companies he's going to. I'm like, oh my God, I'm so glad the tech guys are back. He goes, Mom, they never left. They stayed. They were in San Francisco the whole time. So again, there have been these shifts, and this happens periodically, but it is not as dramatic as it seems in the headline a lot of times. And in inventory numbers that they kept going in the last 2 months, oh my God, inventory numbers are increasing. Oh my God. Like the sky is falling. And then somebody reads that headline and they think, oh, I'm going to wait to buy because the housing market is going to crash, right? So they're blowing it because guess what? That inventory increase has been in 4 states and still in most places is way below pre-pandemic inventory levels. So again, you have to know what the heck you're talking about and be aware of a bigger picture. But then, in your market, what's happening. So you want to know what's going on at the national level, but what's going on in my neighborhood. So I just think that the overall, yes, affordability is not great, but I was saying the other day or a couple weeks ago, it's the best it's been since February. We should all be thrilled.
Yep.
No, but seriously, with the rates coming down, it has helped a little bit, not tons, but a little bit, right?
Yeah.
Okay, I just want to take a quick minute and address a question we had in the chat. Somebody said, what type of second lien loan can I get for a client who started remodeling construction down to the studs and exterior walls open in the kitchen? B of A declined his HELOC once their appraiser saw open construction. Can I do a second with a Freddie renovation loan? Can I use a bridge loan? What lender does this? Please help. Okay, you're going to have a ton of problems with this. So here's your only option. If you can find a HELOC lender that doesn't require an appraisal, and you somehow can get it through title and escrow because they don't want to deal with this either, you're going to have to do some hard money thing or something.
Hard money is your other option.
I'm sorry. We apologize. Private money. We don't
Private money. Yeah.
But the bottom line is you're going to have issues. You do not, I always tell my clients, you do not ever want to start a construction project without more than enough money because you can't get one in the middle.
It is the hardest loan to get is an in-progress construction loan.
And title doesn't want to insure them. So look for it.
So what has to happen, just so that because the lender has to get sign-offs from all of the contractors that did work on that project, releasing any liability or claims of mechanics liens, because a mechanics lien takes precedent over.
It is. So she went on to say the client doesn't want to give up his first mortgage at 2 3/4. Well, buddy, you blew it. So I hope you can find something else, and maybe you can. It depending on the loan amount, maybe you can get something that doesn't require an appraisal. But again, you're gonna have title issues, and that is got a lot of hair on it. So yeah. So there you go.
So can I ask you something from my understanding? So is it because I'm not in this world, so is it because they demoed the house prior to getting to the loan? If they got the loan in advance, it would have been easier?
It would have been fine.
Yep.
Because part of the construction loan is demoing the house. But you demo a house, now you have a house that's mid-construction. The person who did the demo would have to sign off, and the lender would have to be satisfied there's no other contractors out there that possibly could throw on a mechanics lien onto the property.
Yeah, exactly. Okay, so we had somebody who said they were looking to re-listen to our show last week, but it isn't posted yet. It will be shortly. So again, we have Jason who volunteers to do this for us, so we are on his timeline, and he's been driving around a lot. So anyway, yeah, he'll get it up there, I promise. And there you go. I had
an interesting stat on the parting residents leaving the state of California. So I have a good friend who works for Beacon's moving company. It's a big moving company. I think they're national. And he's always like, oh yeah, we're always moving more people out of the state than we're moving in. And I said, well, that's because think about who hires you. People who hire you are established, okay? They have, they're now retiring, or they have a new job somewhere else, and they have the big house, and they have to move from here to North Carolina. But who's moving in? It's college students. How do they get here? They throw everything into a van or the back of their truck, and they move here. And then they accumulate all this stuff, and then they hire you to go back to wherever they came from later on. So their stats will always show there's more people leaving California than moving into California.
That's a good point. Exactly. Yeah. I never really put too much in those van, there's the van lines, stats that, yeah. I don't put much into that, but yeah, good point. And, the other thing, I always go back to when I think about California, what's happening, if we really were losing that many people, we would have seen home prices come down, or
Uh-huh.
we have not seen home prices come down. And so, for better or worse.
And I've seen the stats because you can just go by the population.
Mhm.
And it's like, okay, but yet the population is still growing each year. We're not growing as fast as maybe a Florida or Texas is right now, but Texas is really a booming town or state, and will continue to be so. It's in the right place, the right time, as far as energy production, job creation. It just is in the right spot. It's not anything to do with their politics or anything else. It's just they're in the right place at the right time.
Yeah, and if you don't mind living inside 5 months of the year while it's, crazy weather, knock yourself out. Okay, so home equity, let's just talk about that for a minute, because that's kind of the bright spot. So we've had, everyone has, okay, let me back up. 960,000 people do not have equity in their houses. Everyone else does. It's so many trillions of dollars in equity. Total equity is $17.6 trillion out
And
there.
that's just for people with a mortgage. If you
Right.
take people
Thank
who
you.
own free and clear, it's 32 trillion.
Yeah, isn't that something else? So we have a 340 million in population, 136 million households, 45 million people are renting. That's 33%. So that's, go get them, people, because they should probably own a house. But of the 67% or the 91 million who own, 56.5% have a mortgage, and 34.5 million own their houses free and clear. That's incredible. Those are big numbers. So when you're talking about housing crashes, when you have 34.5 million people who own their house free and clear, and you have 960,000 people who might have a slight negative equity, you're not going to have a housing crash, right? Am I missing something?
Right. The other thing is, over the period of the last couple of decades since the great financial crisis, we've deleveraged significantly. Households have deleveraged, right? And so back then it was 70% loan to value nationally. Now we are down to like 42% loan to value ratio. So that means that on average, people have more than 50% equity of their loan, right?
Yes.
And so so that's huge. I mean, that's a huge difference. The other thing, we did recently is, because of this concern around housing crash, is we looked at what the impact would be if nationally home prices went down like 10%. And basically that, in terms of negative equity, that would put, what did we calculate? Shoot, I don't have the number on my fingers, but the point is, it would be less than 10% people underwater. When we came out of the great financial crisis, 40% people were underwater. So for us to be back in that situation, we would have to see home prices fall by 40%.
Wow.
And maybe home prices will fall a couple percent, but they're not going to fall 40%, because go back to that, imbalance in supply and demand, and the fact that, over the last 20-year period, we basically haven't even been building at half of what we would have need to build to meet up that population growth that we've had. So, the backlog is huge.
Okay, let's talk about the inverted yield curve, which is no longer inverted. So we've had a lot of talk about this over the last few years because it was inverted, which is not normal. Adjustable rate mortgages were upside down. It made almost no sense to do one versus a 30-year fix. And now that has shifted. Can you walk us through that? Like, what happened? What's normal? What's not normal? Tell us about that.
Right. So normal is for the yield to be positive, and the yield is generally the difference between the 10-year treasury rate and the 2-year treasury rate. When the 2-year treasury rate is lower, right? So I'm trying to think of the math. Basically, when people have a perception that there is an imminent recession or a recession over the next couple of years, they will that usually causes the inverted yield, and that's what's been the case. You mentioned the anticipation of a recession for a long period of time. So basically, starting in 2022, we were anticipating recession, and hasn't happened. the significance of it is that usually means to people that you would have a recession over the next 15 to 18 year period, and that hasn't materialized this time around. And so the fact that, so the significance of it also sort of diminished this time around because it didn't happen, and now people are like, well, is it a really good indicator of a recession? How different was this time? And we talked about how consumers remained so strong, which I think helped. And the fact that we haven't, despite the increases or financial tightening, we didn't have the labor market collapse because companies were sort of hoarding their labor because of what happened during the pandemic. So we didn't have things play out the way, many people anticipated. And now we are here, we are starting the tomorrow, right? Tomorrow is the big day, starting the easing process, and so, I think that finally says, okay, there is no imminent recession in sight. So I think, yeah. So what's interesting too is to see that first time around, maybe we're actually in fact having a soft landing, what that would mean.
We'll see, right? It's anybody's guess. God knows.
So you're gonna have a Fed watch party tomorrow, Audrey?
Yeah, I am. I have to, part of my job. Yeah. So, but the thing is, I think I'm going to be on a plane at that time. So, and you can't stream on the plane. You can download things, but I don't think you can stream live. So,
okay, listen, I'm going to watch it. You can watch it on replay, and then we can discuss it afterwards to make sure I got all of it right. Okay.
Okay.
Oh my God. Yeah. If you had told me 10 years ago this would be my life, I would not have believed you. Okay, so CoreLogic does an investor report on, a report on investor home purchases or property purchases. You guys are about to release yours. Can you tell us a little bit about what you found as far as investor purchases and their impact on the market?
Yeah, so we have a quarterly investor report that basically looks at single family purchases by investors, and then we break that investor into 4 categories. So you have the small investor, which is, I want to say 3 to 10 properties. You have medium, large, and then mega is over 1,000 properties. That's basically what institutional investor, one would equate to an institutional investor. And so, so we know investor activity has been going up during the pandemic and sort of peaked in 2021 and then has been slowly coming down, but still as a share of overall purchases remains relatively high. So what our investor report showed is investor purchases are still at about 24%. The peak was at about 28, 29%, almost 30 actually at one point.
What was the bottom?
The bottom, so we start basically tracking this back in 2019. Before the pandemic, it averaged 16 to 18%. Okay. So, the fact it's come down since the peak, it still remains that 10 percentage points higher than it was going into the great financial crisis. One thing is that you have more transactions now happening between investors, and that could be contributing to that higher share. But, so a couple of things there, when we talk about investor activity, people always think just institutional investor, but it's actually small and medium investor that is a much higher share of total investment purchases than in mega. Mega is generally about only 2 to 3% of overall investor purchases are mega investors. The rest are small, like 50% is small investors, medium is another 30 something. So basically the investor share has come down because overall purchases have come down. But what is interesting is that the actual number of purchases has actually gone up a little bit, but just a little bit. Again, this compares, this doesn't even compare to what was happening during the pandemic, during the pandemic. So it's up, but it's slightly up.
Right. It's again, you have to watch what the comparison is from. So I saw somebody else's investor report and they're like, oh my God, investors are such a big part of the market and they're growing. And, basically the idea is they're taking away inventory from the, average family who just wants to buy a house and how bad that is, et cetera, et cetera. But when I took a little dive into their report, it was, it's up 3% from like really low numbers. And you know what I mean? So the comparisons, you got to watch these statistics and these graphs and these, that kind of thing, because they're just so misleading sometimes. It's incredible. So, well, I mean, it would just be sad if we didn't discuss PPI and CPI really quick, since they did come out in the last week. So just give you the quick headline news, not to be confused with headline PPI or headline CPI. So PPI headline was up 0.2 month over month, 1.7% year over year. Core was up 0.3 month over month, 2.4% year over year. They had negative revisions, but they were slightly for the previous month, but they were slightly higher than or hotter than expected. CPI was, the headline was up 1.87%, and it went from 2.9% down to 2.5%. Core was up 0.28%, and it stayed the same at 3.2% year over year. So the shelter components are still impacting, and the motor vehicle insurance are really impacting some of the inflation numbers. So can you speak to, what do you think is going to happen coming up? Because, again, we're thinking we're headed in the right direction with inflation. Do you agree with that? Are we on a down trajectory as it looks like?
Yeah, so I think we are on a down trajectory. You'll have fluctuations, obviously, as we do have with every other data point. So I think everything is moving in the right direction except the housing component and then that insurance component. And so, which I think on the insurance component on a year-over-year basis is going to start coming down. The issue with housing is that it really is one of those, old news kind of things, because it's tracking something that happened over a year ago in the housing market. The other thing is, when you talk about BS numbers, I think every economist that has discussed housing component of CPI at this point agrees that it makes no sense anymore, because more timely data on rents are suggesting that rents are actually have slowed, have not picked up pace. In some markets, they're actually falling. Markets where you've had a lot of new multifamily construction, like Texas, for example, being one of them. But we are not seeing, and we have an index that is a leading indicators to shelter component, which is single family rent index. And that has not picked up pace. Actually, it's been pretty weak. So, I was listening to a podcast earlier, a couple of days ago, that sort of like what is going on with the housing number? And at this point, I think it's just it's that the sample size is too small. They rotated between regions, and that does tend to impact what the reading is, because you're comparing Texas versus, I don't know, where rents are going up right now is Northeast, for example. If you rotate the sample, you're picking up different things, different trends. And so I think that one, that one is what Fed should not be paying attention to, is shelter component, because it's so dated.
Yeah. And it's a huge part of these numbers. It's a huge component. I mean, it's 45.7% of CPI is shelter. Right. And how much of that, owner's equivalent rent? I mean, that's a service,
right? Made up number.
Oh my God, drives me nuts. Okay.
I mean, you ask me how much I'm going to rent out my unit for, I'm always going to want higher.
Right.
I mean, we're in the business. I don't know what my place would rent for God's sake. It's so ridiculous. Anyway, all right, on that bright note, we are at the end of the hour, and I just want to say thank you again so much for being with us today. We really appreciate your insight and information, and we'll look forward to seeing you again. Thank you so much. Anything else you want to say before we go, Selma?
No, thanks so much for having me. It's a pleasure always to be here with you.
Oh, we adore you. So, all right. Well, thank you. Have a great week, everyone. Go get a loan and close it. There's loans out there. It's happening. Okay. Bye, kids.